Section 3. Interpreting Cash Flow Statements. 3.1 Cash Flow Statement Structure. The cash flow statement is a financial statement that provides information about the cash inflows and outflows of a company during a specific period. It helps users assess the company's ability to generate cash and its liquidity. The structure and format of a typical cash flow statement include the following components. Cash flow from operating activities. This section reports the cash flows generated or used by a company's core operating activities. It starts with the net income figure from the income statement and adjusts it for non-cash items and changes in working capital using either the direct or indirect method of calculation. The result is the net cash flow from operating activities. Cash flow from investing activities. This section discloses the cash flows resulting from a company's investing activities, which include the purchase or sale of long-term assets, investments, and loans made to other entities. It provides insights into how a company is deploying its capital for growth and expansion. Cash inflows from investing activities include proceeds from the sale of assets or investments, while cash outflows include capital expenditures for the acquisition of property, plant, and equipment, as well as investments in other companies. Cash flow from financing activities. This section presents the cash flows associated with a company's financing activities, such as obtaining or repaying capital from various sources. It highlights how the company is funding its operations and managing its capital structure. Cash inflows from financing activities include proceeds from issuing stocks or bonds, borrowing money, or receiving other types of financing. Cash outflows include dividend payments, repayment of debt, repurchase of stocks, and other capital-related expenditures. Net change in cash and cash equivalents. This section summarizes the net increase or decrease in cash and cash equivalents during the reporting period. It is calculated by combining the net cash flows from operating activities, investing activities, and financing activities. The net change in cash and cash equivalents is an important indicator of a company's cash position and liquidity. Cash and cash equivalents at the beginning and end of the period. The cash flow statement typically includes the cash and cash equivalents balances at the beginning and end of the reporting period. These figures provide additional context and allow users to compare the company's cash position at the start and end of the period. The cash flow statement can be presented in either a direct format or an indirect format. The direct format presents actual cash inflows and outflows, while the indirect format starts with net income and adjusts it for non-cash items and changes in working capital. Both formats provide valuable information about a company's cash flow, but the indirect format is more commonly used as it can be derived from readily available financial statements. Overall, the structure and format of the cash flow statement provide a comprehensive view of a company's cash flows, enabling stakeholders to assess its liquidity, cash generation, and cash utilization activities. Understanding the key sections and subtotals within a cash flow statement. 3.2 Cash flow ratios and metrics. The cash flow statement provides valuable information that can be used to calculate and analyze various ratios and metrics. Here are 3 key ratios and metrics derived from the cash flow statement. Operating cash flow ratio. The operating cash flow ratio, also known as the cash flow coverage ratio, measures a company's ability to generate cash from its core operating activities in relation to its current liabilities. It is calculated by dividing operating cash flow by current liabilities. The formula is as follows: operating cash flow ratio equals operating cash flow / current liabilities. A higher ratio indicates a greater ability to meet short-term obligations using cash generated from operations. It demonstrates the company's liquidity and financial health. Cash flow margin. The cash flow margin measures the proportion of a company's operating cash flow to its net sales revenue. It indicates the percentage of revenue that is converted into operating cash flow. The formula is as follows: cash flow margin equals operating cash flow / net sales revenue. A higher cash flow margin indicates a stronger cash flow generation relative to sales revenue. It highlights the company's efficiency in converting sales into cash flow and reflects its ability to cover expenses, invest in growth, and service debt. Free cash flow. Free cash flow represents the cash remaining after a company has covered its operating expenses, capital expenditures, and working capital requirements. It is an important metric as it indicates the cash available for distribution to investors. Debt reduction. acquisitions, or reinvestment in the business. Free cash flow is calculated using the following formula: free cash flow equals operating cash flow, capital expenditures. Positive free cash flow is generally desirable, as it suggests that the company is generating excess cash. It provides insight into a company's financial flexibility and its ability to pursue growth opportunities or return value to shareholders. These ratios and metrics derived from the cash flow statement help assess a company's cash flow generation, liquidity, and financial performance. They provide additional insights beyond traditional profit-based metrics, offering a comprehensive view of a company's ability to generate and manage cash. The metrics derived from the cash flow statement, such as the operating cash flow ratio, cash flow margin, and free cash flow, provide valuable insights into a company's liquidity, solvency, and cash generation capabilities. Here's how these metrics are related to these aspects. Liquidity. Liquidity refers to a company's ability to meet its short-term obligations and financial needs. The metrics derived from the cash flow statement can help assess a company's liquidity position. Operating cash flow ratio. This ratio compares the company's operating cash flow to its current liabilities. A higher ratio indicates a greater ability to cover short-term obligations using cash generated from operations. It signifies strong liquidity, as the company has sufficient cash flow to meet its current liabilities without relying on external financing or asset sales. Cash flow margin. The cash flow margin, which measures operating cash flow as a percentage of net sales revenue, provides insight into how effectively the company converts sales into cash flow. A higher cash flow margin suggests better liquidity, as a larger proportion of revenue is converted into cash flow, allowing the company to cover expenses and maintain a healthy cash position. Solvency. Solvency refers to a company's ability to meet its long-term obligations. While the cash flow statement itself does not directly measure solvency, the metrics derived from it can provide indications of a company's solvency. Free cash flow. Free cash flow represents the cash available after covering operating expenses, capital expenditures, and working capital requirements. Positive free cash flow suggests that the company has excess cash available, which can be used to service debt and meet long-term obligations. It reflects the company's solvency and its ability to generate cash to support its financial obligations over the long term. Cash generation capabilities. Assessing a company's ability to generate cash is important for understanding its financial health and growth prospects. The following metrics derived from the cash flow statement provide insights into a company's cash generation capabilities. Operating cash flow ratio. This ratio directly measures a company's ability to generate cash from its core operating activities. A higher ratio indicates stronger cash generation capabilities, as the company can convert its operations into cash flow effectively. Cash flow margin. The cash flow margin indicates the percentage of revenue converted into operating cash flow. A higher cash flow margin implies better cash generation capabilities, as more revenue is being converted into cash flow. Free cash flow. Positive free cash flow demonstrates a company's ability to generate cash beyond what is required for operating expenses and capital expenditures. It signifies that the company has excess cash available for various purposes, such as reinvestment, debt reduction, acquisitions, or returning value to shareholders. By analyzing these metrics, stakeholders can gain insights into a company's ability to generate and manage cash, which is crucial for assessing its overall financial health, liquidity, solvency, and growth prospects.